Alright, so in the last session, we had left off with this example, and we had talked about getting short here at 96 and having this low at 84 to 85 or so as our extended target. But we said that the reality of this trade was that it was really hard to actually hold it. And let's move to a 1 minute chart to show why that was and kick it off from there. All right, so the zone is down around 84 to 85. Initially, we dropped down pretty instantly here and everything was looking great. We're like, okay, we're easily going to reach 84, 85. But then look what happened. We bounced from 88 all the way to 92. All right, that when you're holding it and you're seeing your profits evaporate quickly on strong up bars, that's scary price action. And it's going to make you feel like you want to just exit and protect your profits. You don't want it to go back all the way to 96 or to a loss, right? And so you would feel scared here and you'd want to just protect it. But then, if you had held, okay, tanks back down, you're like, okay, now we're getting it for sure. But then instantly, all the way back up. And then look at this. Every time you thought you were getting it, it would shoot back up, and each time with strong bars that look like for sure this thing's going higher. So to have been able to actually hold to 84, 85 would have been a challenge. Now, of course, it's not only knowing how far to put your profit exits and which zones to target and when, it's also being able to actually sit in the trade to get to that place, right? And if you've traded before, you know how difficult that can be sometimes. So the question is here, is there something else that we can use to help us actually sit through this stuff and not be so scared about it, not be so nervous? And it turns out that there is. If you remember, technique number 4 was that we can exit at a statistical target, right? So how can we use statistics to help us? Well, let's zoom out again. Let me give you a nice stat that you can use. Alright, so as you see now that we've zoomed out, price did eventually hit the 84-85 zone, and not only that, it actually ended up going through it. So if you had been able to hold through all this crazy chop that when you were sitting through it intraday, looking at a 1 minute chart seemed scary as hell, you would have gotten your exit. But most traders wouldn't have been able to sit through this, and they would have gotten a much smaller exit, probably had gotten out at this really strong spike up to 92 and only gotten a 4-point winner instead of a 12-point winner, all right, or more. So what's a statistical fact that we can use to help us exit? Well, one great stat is that over 85% of the time in normal conditions, we don't get inside days. Now, what are inside days? Well, an inside day is simply a day in which the whole range of the day happens within the range of the previous day. But in normal markets, normal market conditions, that only happens about 15% of the time. So there's at least like about 85% odds that we're either going to break above yesterday's high or below yesterday's low. But then when we have volatile markets, when volatility has just really expanded based on the recent historical norm, that stat shoots up towards somewhere around 95%. Something like only 5% of the time in those cases will get an inside day. Okay? And take a look at your charts. Just take a look at them and see how many times in your market the current day that is trading breaks either the low of the last day or the high of the last day. Just go through them and count. And look at it in times of low volatility and look at it in times of high volatility. And you should see similar numbers to what I just said. Alright? Now, how can we use this to help us? Well, think about this. We know these are times of high volatility. So 90 or 95% of the time, we're going to break one extreme of the previous day. Okay, now you never really know which one, obviously, but context is greatly going to help you here. So if we knew the context was very strong down, and we knew all those things I told you about before, about what usually happens after trend days that there's follow through, and we're hitting a resistance area, and now we're quickly rejecting it, as we see initially, the very quick rejection, right? We have all those pieces of information, and we know there's about 95% odds that we're either going to break the high of last day or the low of last day. What do you think is the likely scenario to be? Do you think it's going to be the low or the high that's going to be broken? Well, obviously, you know, these odds that are pointing to at least 95% chance of breaking one or the other are pretty much lined up with the fact that they're likely going to break the low. Okay? You can be extremely sure, never 100%, but extremely high conviction that it's very likely to be the low. Right? So if we have 95% general odds that we're going to break either the high or the low, but almost everything is pointing to the bears being in control, well then, okay, you probably have 95% chance that it's going to be the low instead of the high. And if the general odds are 95%, 95% of 95% gives you pretty much 90% odds that this low is going to be broken on this particular day. Right? The exact percentages don't matter. It's just knowing that it's extremely high likely, not like 50-60, we're talking about closer to 90%. And when you're trading and you have something that can be as good as somewhere around 90% odds, you can't get much better than that. Okay? And so on this particular day, you got short here, and you see this quick reaction down, and all this context is like this, you have very high conviction that we're likely to break this low. Now, of course, can it be the fact that first it comes down, then it goes back up here, and then it eventually breaks the low? Yes, right? And that's why nothing's that simple. If it was 90% odds that we're just going to come straight down, trading would be too easy, just based on these simple stats. Anything can happen in between, and then we eventually break it. But this is where context comes into play. And I've already explained the whole context, so I'm not going to repeat it yet again. But given all that context, and now given that we see a very quick rejection of this area, it's very unlikely that we're just going to shoot right back up. It doesn't mean it's impossible, but it's very unlikely. And so the very high likelihood, again, 80-90% likely, that if this low is going to be broken, it's probably going to be broken before we go back and go above this area, i.e. it's not even likely that we're going to go above this area, right? That's one. And two, we always realize that the high or low of the day usually comes within the first hour. So now we add yet another stat on there, right? So let's take a look at how all this stuff is building to make you almost sure that it makes so much sense to just hold till this low is broken, despite all this scary action. So first we have this stat that 95% chance that we're going to move either above the high or below the low. Then all the context and odds are telling us that no, it's probably going to likely be the low, right? So we're like 90% sure of that. But now you're thinking here, well, what if it goes up and then comes back down, and that would already put me at a loss? Well, now you have more odds and stats to help you. And those stats are that the high or low of the day, of this current day now, will usually come within the first hour, around 70% or so of the time. Okay? Now, this was only the first 20 minutes or so, but we had a very sharp rejection. And when we put in the context of everything I had just said, you gotta already be thinking this could be the high of the day. It's not only that it could be, it's that it's even likely to be, right? The whole 70% thing is just a general percentage, and you can't know if it's going to actually be the low or the high now, or if it's this particular high. But when you add it to context, we're at resistance, we rejected it quickly, just like everything you learned of how to read the market at reference points. Well, now you got to put that stuff to use. And it's never certain, but you got to trust these principles that just play by the probabilities. So you got to already be thinking, man, this is likely to be the high of the day right here, after we quickly rejected it so fast. But then if that wasn't enough for you, At this bar, which never reached your zone, you got down to here, but then it quickly snapped back up. But at this bar, the low of the day was broken. And it was after the first hour. So now it's almost cemented pretty much that 70% chance that we won't go back up above it before coming back down. So yeah, now you have this 90% chance that we'll break the low of the day and 70% chance that'll happen before going up here. That's more than good enough. When you're talking 70, 80, 90, you always got to go with those odds. Don't think about the losses, don't think about losing profits, just go with those odds. That's how you have to think. Because if you do that, yes, once in a while it won't work and you'll lose it and you feel bad, but overall, do this 100 trades in a row, you're going to come way ahead. Okay? So combine all those things and it's a no-brainer to just hold till this low is broken. And you don't have to wait for a major breakdown like this. It could be only a couple ticks below this low and you just quickly take your profits there. But hey, you just got a 12-point trade. And you were able to sit all through these things because you combined this, technique number 4, you use statistical targets. You use stats to help you stay in a trade and go for the extended move. Okay? So I hope you see how powerful this can be. It's very strong stuff. And you can never apply the stats blindly. They're always going to come after you've read things contextually, after you've read the behavior of the market at a key reference area. And if it tells you, hey, the bears are in control, we could potentially have seen the high of the day, then you can hold for those extended targets and be pretty confident that, for instance, the low will be broken. Or on the upside, if everything was looking bullish and we had just put in a tail and now we had snapped back up off a support zone, well then most likely we're going to break out the previous day's high. It's not rocket science at that point. It's never certain, but you can quickly make those kind of deductions and just trust the odds. Having said that, I've just shown you several of the different techniques in action and how you can combine techniques. In this one, we combined the next support or resistance zone with a statistical target to make sure that we were much more likely to actually hold it till we get there. Again, that's the important part. It's not just picking a zone, it's actually being able to stay in the trade till it gets there. And like you see, to do that, you're going to have to sit through retracements. You're going to have to sit through the discomfort of seeing your profits looking like they're evaporating and then come back and all of that. That is part of it. And you'll never get those big trades, rarely ever, unless you're willing to do that. Yes, sometimes they'll just take off in one direction, for instance, like here, if you had gone short here, just went down 15 points instantly. But those are rare. Most of the time you're going to have to sit through good retracements. And one last little thing that's not so little, it's actually quite important, is that last rule, rule number 3, which tells you not to micromanage your exits on a smaller time frame than you got in at. Okay, so let's quickly take a look at that in this example. Alright, here we are on a 1-minute chart of the same trade, and you had gotten short here at 96 and you had been riding it down. Okay, now here's the problem with micromanaging a trade. You see it popped back up on this breakdown. It showed a very extreme tick reading, like minus 900 compared to the rest of the day was showing. This whole down move only showed you minus 500. Now you're hitting this extreme, right, on a very sharp down bar. So if you're sitting there trading this and your zone is 84, 85, and you see this, you go, oh, was this a short-term exhaustion? Maybe I should get out. I don't want it to reverse, right? And, if you don't get out and it does reverse like this, you're kicking yourself and you're taking your exit here at 89 instead of at 87, and you're thinking, next time this happens, I'm definitely going to get out here. And of course, you're picking up wrong lessons, right? Because first off, yes, this is extreme, but not when you look at the bigger context. This wasn't coming, in an uptrend and then we got this to serve as a short-term bottom. This was coming in a down move, and it was coming after we had already popped back up, not after extended down movement with no retracement. This was first coming after a retracement, so that's number one. Okay, it wasn't like this capitulation move from straight down movement. That's number one. And number two, and more importantly to the point that I'm trying to make here, is that you entered this whole thing based on the bigger picture down movement, based on the expanded volatility now, based on the statistical target here. Everything's pointing down, and now you want to get out at this short-term exhaustion. Well, that wouldn't make sense in this context, right? In another context where you had gotten in just for a normal rotation and you wanted to get out at 4 or 5 points, and then you saw something like an extreme like this, okay, then it might make sense to get out. That's not micromanaging, that's sticking with the whole hypothesis of your entry. But the whole hypothesis of your entry here is that you're combining much bigger picture conviction with everything else. So why now are you getting out on a 1 minute tick extreme? Right? Even if it does cause this pop back up, that's no reason to get out. Now you might be thinking, well, what if I get out and then reshort here? Well, that sounds logical, but it's much harder to put into practice because a lot of times you'll get this, but then it'll just keep going. And if you had gotten out, you wouldn't have even gotten a chance to reshort. So try to stay away from trying to finesse it like that too much. So that's the first thing. Don't do this kind of thing. If you have the bigger picture, just stick with it. Number two is like looking at divergences. For instance, look at this. So we got this big down move and we got the tick spike. And then we came down and we made new lows in the S&P, but tick was diverging. So does that mean you get out here? Well, it's only like a 1.5 away from your target. Does it make sense? Well, again, this is micromanaging. You would be getting out at this mini divergence on a 1 minute chart that happened only 15 minutes apart, ignoring the bigger picture, which is all the statistical odds and the bigger picture move and how the bears are in control. This is micromanaging. You're entering based on this grand contextual thing, and you're exiting based on this little intraday 1 minute thing. Don't do that. All right, that's all I can tell you. You're going to see these over and over and over again, and they're going to be very tempting to fake you out. You only want to get out before your real zone hits or anything like that if you see something major. In this instance, pretty much almost nothing would have gotten you out based on the stats. 90% odds of hitting this, already 70-80% odds that this is the high of the day. You just want to stick to it. In other instances, you might not have those clear odds and everything lining up, in which case you can get out ahead of your zone if you see something meaningful, not a little 1 minute chart divergence or a little exhaustion that's not even in context. You would have to see like a major exhaustion, okay? Or you would have to see, a double, triple divergence over time in the advanced decline line and the tick, showing that the potential is for a pretty big reversal before your zone is hit, or maybe your zone won't be hit. Then it makes sense to get out. All right, so there's no hard and fast rules about this, but just make sure you're not trying to micromanage things too much and paying attention to the little things too much. That's it. And with that, we've gone through some examples, we've gone through quite a bit of detailed stuff, but in reality, there's an infinite number of examples, and what you need to do is study these, go back, review this video, review the key takeaways in which I'll highlight all these things in detail. But the main thing is to take the principles, which I've just shown you them in action, study those, and keep reviewing the market. And at the end of each trading day, when you're done trading, think about how did these principles play out in this instance, in that instance. That's how you learn. That's how we ourselves learned from experience, but you can accelerate your learning and your experience by reviewing things, by having those principles clearly in mind, trying to apply them each day. And when you make mistakes or you make wrong judgment calls, don't feel bad about it. Review it at the end of the day. See what the market told you, see where you might have went wrong. And sometimes, you didn't go wrong. Sometimes things just don't play out like we plan. These are all odds at the end of the day. There's never certainty. But the reviewing process, the studying process of the market will greatly aid you. It'll allow you to be able to start putting these things into action yourself in your own markets consistently. And that's the important part here. And having said that, now we're going to move into looking at trend days. We're going to look at the difference between trend day setups and everything you've just learned so far, and then also the difference in how we exit when we're looking at trend days. There's going to be some similarities, but there's going to be a couple major differences. So that'll be very important for you to learn too.